Okay, good evening, everyone. I'd like to thank you all for braving the rain to come out and support us today. Today, we promise to give you a lot of information about how to finance your own or your child's future tertiary education. As you may know already, the cost of tertiary education is a problem all over the world. As you can see from this picture, people are rioting in the streets in the US, in the UK about student loan debt, about being unemployed after graduation, about being underemployed after graduation, and about the hiking cost of tuition. Bearing that in mind, we must recognize that although education is a right, college education is a privilege. And education is expensive to everyone, and it's expensive everywhere, not just in Jamaica. And considering those facts, the options for financing your tertiary education is really not as limited as you might think. Considering the struggles that you'll have to face when financing tertiary education, the question you have to ask yourself is, how important is it to you? How many struggles are you willing to face? What sacrifices are you willing to make? And do you think that it will be worth it at the end of the day? So the basic options for financing college education is to get a student loan from the Student Loan Bureau, to get a bank loan, to pay from your savings or your investments, to pay from some sort of cash value insurance, or if you're lucky and really, really brilliant, you can get a scholarship or a grant. If it's just around the corner, say your child is going to college in another year or two, your options thereafter are severely limited. You can consider getting a secured bank loan if, for example, you have assets, you have a house, a car, you have some money saved up. You can borrow against them to pay for your child's tuition, or if you decide to pay for your own tuition. You can dip into your life savings. This is definitely not recommended. But some people do that because, you know, they really want to give their child the opportunity to get a good start in life. However, once you've spent that money, it's a lot more difficult to save it the second time around. The other option is to get a student loan, as we've said before, or to get grants or scholarships. We won't go into much detail about, well, we won't go into any details about grants or scholarships because the options in Jamaica are very, very limited. And really, if you're looking to get a scholarship, it might be best if you go to school overseas. Not to, you know, kill the local tertiary institution. I mean, you can go and come back. You know, we recommend that you go and come back. So, say you decide to get a student loan. This is how most people think about a student loan. But I will say that the loan that the Student Loan Bureau offers is really the best loan financing option that's available in Jamaica for paying for your tertiary education. Why? Because you have the lowest unsecured rate available compared to if you were to get an unsecured loan at a bank, you're looking at anything from 18 to 30%. 9% is really unheard of. You're not required to make any payments in college. Banks don't do that. 6 months grace period after graduation, even in the US, you don't get that much time. I had a student loan when I was overseas. I only had 3 months to get a job and start paying my loan. And I think the student loan product does compare well with other student loan options that are available internationally. So basically, your strategy for repayment should be to reduce the speed at which interest accrues on your loan by making early payments. You want to repay as much as possible before your 6-month grace period ends. Do not wait until when your payments are due to start making them. Or you can choose to rough it, get a job, and pay on your own and just don't get a student loan at all. So how can you repay your student loan faster? The first thing is psychological. Accept that you have a responsibility and be ready to take it seriously from day one. Once you get your mind right, the rest of it becomes easier. The next thing you need to do is get informed and make a plan. Find out from your loans officer, even if he thinks that you're annoying, even if the executive director of the Student Loan Bureau thinks you're annoying, Get all the details about what you're getting yourself into or what you have already gotten yourself into. I mean, what's the rate on your loan? How much time do you have to repay? What's the penalty if you miss a payment? Can you pay before the due date? How much, I think I already said how much time you have to repay. But get as much information as you possibly can. Next thing you need to do, pay early and pay frequently. So even though you are only required to pay once a month, the more often you pay, the slower the interest accrues on your loan. Try to make payments while you're in school. Annalisa spoke to that. And that will reduce the balance that you owe the student loan at the end of your graduation period. One thing you can do, and this is what parents are for, ask your parents to make some payments to your loan for you. And you might think, well, if my parents had money, then I wouldn't need a student loan. But, you know, maybe they can make a $500 payment every month or every fortnight or something. That will be a big difference for you when you graduate and you have to repay a student loan. The other thing you can do is get a part-time job while you're in school and make sure that you work every summer to be able to pay your loan every month while you're in school, even though the payments are not necessarily required. The earlier you make the payments, the less you have to repay when you graduate. And getting a job in school, it's a double benefit. You get to network, you get some experience, which means that when you graduate, you spend less time being unemployed. Party less and enjoy yourself more creatively. With a little bit of liquid inspiration, we all know what that is, anything can be enjoyable. And parents, don't think that your children don't do it. You did it, they're going to do it as well. Now that you've had your job, you know, you're a waitress, or I was a waitress. It's a terrible job, but, you know, you have to do it. You're a waitress, or, you know, you work at Mega Mart or something. Make sure you join a credit union and save regularly. What that will do for you, it will help you to build some banking history, help you to build some credit history, so that when you graduate and you want to buy a nice pretty car, it will be easier for you to do that. If you want to refinance your student loan, it will be a lot easier for you to do that if you already have a relationship with a financial institution. Other thing, do not miss any payments. Once you start to miss payments, it's like you're digging yourself into a perpetual abyss that you'll never get yourself out of. Be grateful for the opportunities that you've gotten from the Student Loan Bureau. As bad as it may seem, if it wasn't for them, you wouldn't have a degree. So be always thankful and grateful, and remember that there are people who are coming behind you who would like the same opportunity. So now we're going to move on to parents and paying for your child's education. And of course, this little boy is so cute. He's your son, and I'll call him Timmy. He's your son, Timmy. He's cute, he's brilliant. You think he'll be the president of the world. So you want to give him a good education. Well, you have to consider all the costs of paying for Timmy's tuition or Timmy's education. It's not just tuition, you have to think about inflation. The younger Timmy is, the more it will cost by the time Timmy goes to college. You have to think about books, food, clothes, Timmy's exorbitant cell phone bill that you will receive, and other miscellaneous college fees that you'll have to pay. Best thing you need to do, talk to a financial advisor, get some advice about what will be the estimated costs of college by the time that Timmy goes to college. So these are your options for financing Timmy's education. 1, don't pay. 2, you can pay from an investment. You can pay from insurance. You can pay from some sort of long-term savings account or a regular savings account. The don't pay option. So I know you're thinking, wow, that sounds kind of mean. However, studies have shown that students who have their parents pay the full cost of their tuition tend to do worse in school than students who have to foot it themselves and pay their own way through school. Even though the graduation rates are higher for students who, you know, basically had a gold spoon in their mouths, they basically get lower GPAs. Why? Because they spend more time partying and less time studying. They're also more likely to choose unprofitable majors like art history or something that you never heard of in your life. Oh, oh, really? Okay. Okay. But, you know, those, or they'll choose a major that you don't automatically think I'm going to come out of college and make a huge amount of money. And a lot of times they choose these majors because they're easier and it allows them to spend more time on leisure activities. And so many times these children become a bigger burden to you after they graduate. Why? Because they've chosen a major that's not economically beneficial. They don't have the highest GPA, so they can't get a job. And so they have to move back home with you, where you have to take care of them until they can get back on their feet. And as I said, students who pay their own way tend to do better in college. So the option of investment. Investment option has the highest rate of return. It also has the highest risk. But you have to think that it's really a long-term plan that you have for paying for your child's education. You do get some tax benefits if you choose an investment option, and you can use salary deductions and also standing order payments to fund your investment accounts. So the first kind of investment, stocks or shares, which you know represent ownership in a company. It's a long-term investment option. I've known of people who, you know, when their children were young, they bought, say, shares in 2 companies and say, okay, when little Timmy gets to 18, I'll sell these shares and use it to pay for Timmy's education. And it's actually a good option because over time, stock prices tend to increase. And the longer your horizon, the more likely you'll receive the benefit of the price increase. One good thing about stocks is that you don't pay tax on the price appreciation of your stocks. The tax on dividends is lower than the tax on the interest that you'd earn at a bank. And while stocks represent the highest risk of all the options that we'll discuss, it also represents the highest returns that you could receive. And you can reduce your risk by ensuring that you're looking at more of a long-term type of investment rather than thinking that, oh, we're going to buy the stock today and sell it back tomorrow and expect to make millions and millions of dollars. So these are the companies that you can contact if you're interested in buying stocks. They are the dealers on the Jamaica Stock Exchange. We can send you a list. JMMB is highlighted, not because we're promoting it, but because JMMB is probably, of all the ones listed here, the one that requires the lowest starting amount. The other option is bonds, which is a loan to a company or to the government. And you get the benefit of price increase in your bonds, and also bonds pay regular interest. They pay either semi-annually or quarterly. The interest rates that you get on bonds are significantly higher than the interest rates that you get on savings. In fact, it's probably the highest interest rate that you could get in Jamaica. It's really, a lot of people think that I have to have a lot of money to buy a bond. Really only need $5,000 to buy a Government of Jamaica bond. You might think, well, I don't want to buy no Government of Jamaica bond because I don't trust the government. However, if you think about it, when you put your money in the bank, what the bank does is buy a Government of Jamaica bond and then pay you a portion of the interest that they earn on the bond. So you're better off just buying the bond yourself and earning the full interest. Interest on bonds are actually taxed. They are taxed at 25%. However, even though it's taxed, you still, at the end of the day, get more money than if you had put your money in a savings account. If you buy something like a global bonds are not taxed at source, which means that they pay you the full interest. The onus is then on you to go to the government and say, oh, I've received this money and I owe you this much of it. bonds make for fruitful foreign currency investment. If you're aware of the interest rates in Jamaica right now, the interest rate on a US dollar savings account is next to nothing, basically. And even if you have millions of dollars, it's only slightly more than zero. So these are the list of people that you can contact if you're interested in purchasing bonds. So maybe you might think bonds are too risky for me. So you can think about a pooled investment option. You can think about buying a mutual fund or a unit trust. Mutual funds are usually denominated in foreign currency because they're not actually local instruments. Unit trusts are local instruments and they are denominated in Jamaican dollars. But what they do is that they allow you to put your money with a lot of other people in Jamaica and share the risk of owning things like bonds and stocks. It also opens up a lot of investment opportunities for you that you wouldn't otherwise be able to access. If you're like me, you're not rolling in the dough like that, it allows you to access investments in high value real estate, private equity, international bonds, stocks that are probably on the US exchange, Canada, Japan, China, where you wouldn't normally be able to access investments in those instruments. Also, for unit trust, if you hold your unit trust for 5 years and don't make any withdrawals, all the gains that you make on it are completely tax-free. And these are the companies that offer mutual funds and unit trusts, and we can send you a list of these afterwards. You can think about specialized investment accounts. Barita has a product called the Tuition Builder that's structured specifically to help you to save towards your child's tuition. You have a product called Mayberry Gold, which is a fund that's invested in local equities. And you can also choose repurchase agreements. This is something that's sort of being phased out right now. It sort of operates like a fixed deposit account, only it's offered by an investment company. Insurance options. You can choose to use an insurance option, maybe if you think that I don't have the discipline to commit to something like an investment. An insurance option ensures that you make specific monthly payments every month. So NCB Insurance has a product called the Omni-Educator. It's a product that is geared specifically towards financing your child's tertiary education. You can earn tax-free interest on this account if you hold it for 5 years. The good thing about this is that you can actually get a 20% grant towards your child's tuition. And that's not 20% of the tuition, that's 20% of the money that you've actually saved. It also gives you some life insurance coverage, and you can start with as little as $1,000 a month. Scotia Mint also has a great product. It has some of the same benefits, and your child, once you have a Scotia Mint, your child can actually qualify for an annual scholarship for high school and for college. They have an inflation-linked option where you can actually increase your contributions to the Scotia Mint account based on how inflation is moving in Jamaica, which ensures that by the time little Timmy gets to college, you actually have saved the right amount of money. And you can start with about $2,000 a month. Guardian Life has a product called Guardian Accumulator. Same benefits. But one good thing about this is that it has something called a parental waiver benefit. What this allows is for your policy to continue if, for example, something happens to you as the parent, say, God forbid, you die or you become disabled, the policy doesn't just lapse and your child doesn't get anything. The policy actually continues until your child reaches of age and he still gets the benefits. There's another policy called Guardian Investor. It's a 15-year policy. It's basically an insurance policy that you contribute to for 15 years. The contributions are invested in equities, and as we stated before, equities give you the highest rate of return. And after 15 years, it matures and you get the money to pay towards your child's education. You can try high yield savings accounts like fixed deposits. Most institutions offer that. And as I said, they offer lower interest rates than any other options that we've discussed before. It doesn't really require active involvement. You know, you just sort of put your money in the account and you earn the interest and you pay over your 25% tax to the government. But some of them do have some great tax-free benefits if you hold them for a certain period of time. Some of the options in the market are golden harvest accounts. These are issued by almost all credit unions. First Heritage Credit Union has something called a Prosperity Plus account and the Supreme Saver account, and I'll admit that these two accounts actually have a pretty decent interest rate. It ranges from about 8 to 6%, which is good compared to the 0 and 0.1% that other institutions are offering. VMBS has an iSave account. GMMB has a tax shelter, which is an account that you hold for 5 years and all the interest is tax-free. Or you can get a run-of-the-mill fixed deposit. You can find more information about savings, fixed deposits, and repurchase accounts by visiting our website at rate-b.com, where we allow you to compare all of these institutions and find the ones that actually offer the best interest rates. So, now that I've given you all of this information, you're probably saying, boy, how am I going to do this? So, what you need to do, and these are some tips to help you to stick to your plan, right? You need to start early. I won't say the minute your child is born, but you know, as soon as you get over the excitement, you need to start planning for your child's education. The earlier you start, the less you need to save. Make sure you use a salary deduction option, especially if you know you're not disciplined. Use salary deduction or standing order. This will ensure that your contributions get to your accounts on time, every month, all the time. Choose an option that doesn't allow easy access to your funds. Choose an option where you have to walk through fire and go through bush and probably fight some sort of gigant or something to get back the money, because this will ensure that you don't take Timmy's tuition and expand on your house or put in a solar water heater or put in something ridiculous, buy some flat screen TV, and Timmy definitely has his tuition money waiting for him when the time comes. Make sure that you increase your savings as your salary increases. I know you're thinking, boy, my salary don't increase for a long time now, but we're keeping our fingers crossed that things will get better and your salary will increase so you can increase your savings. Go for tax-free options that ensure maximum returns. The fact is, the less money you pay to the government, the more money you have to pay towards Timmy's tuition. Ensure that you have other long-term investments for retirement, for emergencies, or for some sort of luxury vacation that you want to take, because this also reduces the chances that you'll dip into this fund, and it ensures that you'll have enough money to pay for your child's tuition. And set periodic goals for yourself. Something like, okay, after 5 years, I want to have saved X amount towards it, or after 10 years, you know, I want to have accumulated Y amount of money. So how can you fit this into your already diminishing disposable income? You can think of doing things like carpooling if you're not doing that already. Buy in bulk with family or friends. If you have extra space in your house, rent it out and make some extra money. Eat healthier, you know, eat more things from the market, eat less Rice Krispies, eat less Burger King and KFC. The healthier you eat, the less it costs you, because most of these foods are actually tax-free. And as you know, GCT is what, 16.5%? That 16.5% could have gone to Timmy's tuition. And eating healthy is cheaper, not only short term, but also long term, when you realize that you haven't contracted diabetes and hypertension from your unhealthy diet. Cook more often, that speaks to the point before. Learn to do things yourself and sell your skills. So if you're good at doing hair, do your hair. dear friends here and charge her for it. Or do somebody's nails, or go and learn a skill at heart and do something that you can actually sell, make some extra money that you can save towards your child's tuition. Once your child gets to school, never buy new books, buy used books only. Never pay full price for anything.